Hi everyone. Welcome to episode 4 of Compounding Brothers. I'm Paul.
I'm Joaquin. Hey, Paul.
How are you?
Doing great. Looking forward to sharing
Fantastic.
this amazing topic that we have prepared with you today.
Yeah, we've got an interesting one today. But before we start, just everybody quickly read our disclaimer. In short, these are our opinions, and they are for entertainment purposes. And please discuss anything that you may want to invest in from this program, and speak to your advisor.
We had 3 episodes before this one where we started with the picks and shovels around chip manufacturing, the Technium wave, and then we moved into a related theme associated with the energy transition. We discussed the opportunity around natural gas as the transitional commodity energy feedstock for the Technium to continue growing. Then we moved on to the opportunity around solar and batteries, and we talk about a couple of players that we like in lithium. It's interesting, Paul, that since we spoke about these two, I was checking Albemarle went up 24.6%, and SQM, the one you liked, beat mine and grew 26.4% in prices. Again, past returns are not indicative of future returns, but we are onto something here. And we think that this is just starting. Then we moved into the fiscal dominance theme. And the fiscal dominance theme, we started discussing the opportunity around gold miners. The group did great in the last 2 weeks for all the developments in the marketplace, and mining company stocks went up between 12 and 20%, just the ones we touched in the last 2 weeks. So clearly, most of the themes are working very well, and within the themes, the companies that we like and we follow and we invest in are doing terribly well.
Yep, we are having a good run, and our theses are being played out quite well, I would say. So now we go on to the news of the last couple of weeks.
Yeah. So last week we talked about the fiscal dominance and the gold mining opportunity. We talked about how important it is for the U.S. as a country, and in particular for the U.S. government, to start moderating interest rates. We spent time talking about how the trade policy is related to that, because the trade policy is an instrument to reshore, is an opportunity to collect taxes as the imports come into the country, but also by revitalizing the hollowed manufacturing base. And we spent time trying to understand why is that tariffs are not inflationary. And one of the things that Paul and I came across, the news just came out. The CPE was reported this past week, and interestingly, the inflation rates month on month, which is what you had on the right, showed deflation. So this is not that there is no pass-through from tariffs to goods, or that the pass-through is tame. We're seeing deflation, which is exactly what we thought was going to happen. On the right-hand charts, you can see goods in month over month minus 0.1. And on the left-hand side, we have the year-on-year percent change on personal consumption expenditures. And while the overall inflation rate measured by this index was at 2.6 versus the same month a year ago, the goods contribution was 0.5. So goods increased significantly less than services. And I thought interesting to quote here someone, I'm going to let you guess, who said, turning to inflation, higher tariffs have begun to push up prices in some categories of goods. So this individual thinks that tariffs are generating inflation, and we're seeing deflation. We're seeing declines in goods. And then they say, essentially saying that this is, again, a problem. So would you guess who was this individual?
But I can only guess it was Jay Powell.
It was Jay Powell. This is an excerpt from Jay Powell, Jackson Hole speech this past week. So again, is clueless, completely clueless. As part of his speech, he admitted that his prior monetary framework was flawed, and the new monetary framework he's using is also flawed. So, so we have someone who is a lame duck chairman who is stubbornly resisting easing the monetary stance, and in the same context, they are still thinking that immigration policy and trade policy are going to create problems. And you have so-called experts as the American Enterprise Institute who think that the immigration policy is going to be detrimental to growth, which, as we're going to see in a minute, is not going to be the case. To the contrary, it's a reversion of trends that have significantly impacted workers.
That's right, and impacted them for the worse.
Yep. So again, you and I discussed how it was going to be a house of horrors for the Fed, and we were not disappointed. The administration turned on or heightened the pressure and the heat on the Federal Reserve as they found one of the Fed governors, in this case Lisa Cook, allegedly committed mortgage fraud. And we thought that Lisa Cook had committed 2 instances of mortgage fraud, when in reality, we just learned there was a third one that actually was during her tenure as Fed governor. And I went back and tried to understand. Clearly, we're not lawyers, and we're just trying to understand and handicap. We think she's going to be removed, and that's going to open a third seat that is going to probably give the administration a controlling position. So the sort of the center of gravity of the Fed is going to shift, and that's going to move in the direction that we anticipated.
And just for everyone to get the big picture here is this Fed governor, when getting a mortgage for a property, claimed that this was her primary residence, and that allows her to get cheaper rates because of government subsidies. And she basically, on 3 homes at the same time, she marked that it was her primary residence. So, unless she's got a 3-dimensional way of living that we haven't figured out yet, she's lied.
So she declared with 15 days of difference that 2 homes were her primary difference. The 2 homes were her primary residence, one in Georgia,
one in Michigan, I think,
and the other one in Michigan. And both homes seems to be rented out immediately thereafter. But then it just surfaced that there is a third home. She declared a Massachusetts property as a second home again. But then when she filed her financial disclosures with the Fed, she said that those were investing. That's were for investment purposes, and she's collecting rent on that. So she lied again. So the interesting thing is the statute of the Federal Reserve. So the Federal Reserve Act says that the president is the only individual who can fire someone for cause. It doesn't describe what cause is, which leaves it very open, and clearly a breach of truthful disclosure completely disqualifies her to be the mortgage regulator and the Federal Reserve governor in the country. And it's interesting because one of the arguments that she used is that this is personal property. And I thought to myself, serving the government is not personal property, it's a privilege. And if you have someone who commits fraud, the question is, what do you do? Do you let an individual like that continue occupying one of the most important offices in economic policy in the country? And if the president doesn't remove her, who does? In fact, right, there is precedent There is, you can see there, Richard Clarida, who is now at PIMCO. He resigned, even though he was proven innocent from any insider trading. He resigned the same as Robert Kaplan, who is now a vice chairman at Goldman Sachs, and also Rosengrant. They traded bonds and stocks in February 2020. They traded perfectly within the ethics regulations that the Fed has. But when these issues surfaced, they resigned immediately. And the rationale was, we need to protect the reputation of the Federal Reserve. And any of these trading allegations is dramatically less concerning or worrying or grave than mortgage fraud. In fact, the Justice Department chases individuals for what they called occupancy fraud, and they send them to jail. And these people are not people making $300,000 a year as Lisa Cook in a very cushy protected job. Hardworking people that sometimes think they can cheat the system, and they are sent to jail. So I think, I hope that for all the reasons above, she comes to her senses and she negotiates a settlement, and we have her out pretty soon, because this is a disgrace. It's disgraceful that we have someone at that level in government being so insensitive to protecting the reputation of one of the most important and revered financial institutions in the country.
But what's interesting is, obviously somebody was looking for a way of reducing the, let's say, the power of the Fed to hold steady, and this is a clear message to the Fed governors that you're going to be looked at with a microscope if you don't sing to the tune that Trump wants you to sing to, which are cuts as soon as possible.
Yeah. So I think you can always be suspicious of the motive, but again, I ask the question again: if you have someone who is completely obliterating the reputation and putting a dark cloud over the entire Federal Reserve, if the president, who is the only individual who has the statutory ability to fire her, doesn't fire her, then what?
Yeah, then he becomes complicit, if you will, in the mortgage fraud.
So it's a no-brainer. I mean, she has to go, and she shouldn't be forcing the president to fire her. If she made a mistake, if she committed fraud, doesn't matter. The other argument they're making, and the lawyer, I mean, I thought that was childish. That it was a clerical error. The clerical error came from someone who feel. I mean, she is a governor of the Federal Reserve, and she signed multiple documents. And I've gone through the process of applying for a mortgage and declaring my home as primary residence, right? And you need to put that signature in 50 different places. It's very hard for you not to realize what you're writing on. And then there was President Smith, is a president from Kansas, who said that probably the mistake was because the document was too complicated. The document is too complex. And I was saying, if she was going to be governor of the Fed, she better can manage the complexity that we're asking like Joe Schmoes around the country to manage, right? Because when a Joe Schmo commits mortgage fraud, they're sent to jail, and the penalty is up to 30 years of prison, right? So the penalties are pretty stiff. And in this case, you have 3 instances in which she allegedly committed mortgage fraud. I think it's a disgrace. I think she must go. The longer this drags on, the worse is for the reputation of the Fed, and the worse is for all of us. So hopefully, someone is going to tap her shoulder and say, "Just go take a 10-year position at Yale or Harvard, where you have an opportunity to teach economics, and let the central bank run its own business." Right?
Exactly.
So in the same context of fiscal dominance that we discussed in the last episode, there is a boom in this space. We're going to be talking later on stable coins. Here we're seeing Besant and the government and the SEC regulators. They are all behind making sure that the US creates an ecosystem for the US dollar to be the stable coin of choice. And this is going to drive more demand for bonds. And so we're seeing on the right-hand chart, despite all the fear mongering around foreigners dropping or dumping treasuries, there is strong demand. And I think very hard to attribute reason for this, but I think a part of that has to do with this stablecoin and crypto boom that we're going to be seeing for many years to come.
Yeah, I agree. The foreign sources have definitely leveled off, and if we're going to have a reduction in the trade deficit, uh, that is what you'd expect. But we are making it up by this demand for treasuries from these stable coins, which is a good idea from Besant's part.
And as we just touched, this is all around this. This is all the same theme. Is the theme of bringing interest expense and the cost of debt for the government down. And these initiatives around stable coins, the initiatives about the all the reforms around making cryptocurrencies accepted as ways to tokenize assets, the fact that potentially money markets, bonds are going to be tokenized on top of Ether or Solana. Potentially, there may be different alternatives. It's what's going to is going to allow the monetary policy to control the cost of debt, and at the same time, we're going to have soon the administration controlling, quote unquote, the monetary policy to bring rates further down and making sure that the tapering of the balance sheet is done in a way that doesn't disrupt the economic. And I think it's we're just getting to the point that this is becoming an urgency. I think clearly there are signs of cracking in the labor market. Hopefully, the situation is not going to get out of hand. But as we can see in this chart on the right, the jobs hard to get, less jobs plentiful is spiking, and this
A
is
leading
usually
indicator.
harbinger of increases in the unemployment rate.
Yeah, it is a good leading indicator.
And we know that when unemployment starts going up, it creates its own momentum. It's something that you don't want to have to fix. I think one of the topics that I never see discussed by the Fed is the asymmetry between being wrong on easing versus being wrong on tightening. Because if you're wrong on easing, you can always rectify that. You can go up quickly, and then you reduce credit, you manage the repo facility. There are many ways to manage liquidity and time. But if you're wrong on tight or on remaining too restrictive for too long, you create this avalanche, this cascading effect in the labor market, and that's very hard to reverse.
And it's self-reinforcing, so that's what also makes it much harder to get out of.
Yeah. What do you say of this?
Yeah, well, it's it's very it's very clear to see that the Fed is definitely way behind the curve versus other central banks, and it's interesting that the BOJ has started increasing in the last few quarters, which also makes us keep our eye on the carry trade, which could be a source of liquidity drain from the U.S. We think the liquidity additions are going to overpower that, but this can lead to sort of a choppy market as Japan starts selling U.S. assets.
Indeed. If it wasn't so tragic, um, how Jay Powell has been so wrong so consistently for so long, it would be amusing.
Yeah,
In the year to date, to your point, foreign central banks have cut 88 times versus zero at the Fed.
yeah, that's right. It is amazing.
And to your point, the Bank of Japan um, remaining at zero for so long was never a problem. They keep talking about the zero bound. We know now that there are many ways from there are many instruments the Fed can use to escape the zero bound, just increasing the balance sheet, and they've done it, and they've done it aggressively. And one of the things that we thought interesting is that when the first cuts, the sectors that benefit are sectors that we like, and value being clearly one of them. So there is an opportunity for value here that has been left behind, that has been consistently, stressed by us in the last few episodes. At the same time, go ahead.
No. Here, it's a theme that we've been playing in the last 9 months or so, since the beginning of the year when we started buying Chinese equities, and we can see that the liquidity is moving to Hong Kong, and as it moves to Hong Kong, what can it do? It buys stocks. That liquidity turns into equity gains.
Yeah, there is a wave of liquidity being generated by all this easing by central banks. There is, as we discussed in the last episode, significant goosing of the consumer through many different measures, expanded credits, reduced in the reserves banks need to take, direct subsidies, and all this cash is finding its way through the southbound. The southbound is the name for when the money travels from continental China to Hong Kong through the exchange, through the direct interconnect exchange, and that money, as you were saying, goes to stocks. And this is one of the themes that we like, and we like a lot. We think we are in the first half of the first inning on this, and this is going to continue. And the beauty of investing in Hong Kong traded stocks is that you don't have to have faith on the mass of money buying shares. What you can do is be a fundamental investor and look at things such as Alibaba on the right hand chart. Look at what the cash flows are doing in orange versus what the price. There is a gap. It makes my mouth water when I see this. I think, again, this is opinion, not advice. I think there are today we're seeing opportunities to make generational returns.
That's right. And Alibaba knocked it out of the ballpark yesterday.
Yes,
Really good earnings call.
they reported yesterday stock went up 12%. They're firing on their Alibaba. If it wasn't Alibaba, is one again. Going back to Soros, right? You need to discount the obvious and bets on the unexpected. And we make money when you realize you understand something the rest of the market doesn't, and you know why they don't. And that's called a variant perception. You realize there is something other people are not getting. uh, More often than not, the fact that you understand something other people are not getting is because you're dumb, and you think you understand something when in reality you don't. That's why you need to pair understanding something with understanding why they don't. And one of the things, of the many things people don't realize on Alibaba and on this opportunity in China, and on the fact that this is existential for the CCP in terms of sheer survival, in terms of boosting consumption, is that Alibaba not only takes a tax every time, so 40% of Chinese consumption goes through them somehow, so they take a tax every time the Chinese consumers consume, but also they bought into the entire AI ecosystem in China, because they are one of the largest, if not the largest, cloud compute provider in China. Anytime there is an AI company that needs server capacity, it's Alibaba the one supplying it, but the way they get paid is with equity. So they own the entire ecosystem. So last
That's right.
last Friday, yesterday, they reported relatively tame earnings from the e-commerce business, but their cloud business is booming. And this is again one of those areas that people don't see Alibaba as as the AWS of China, but they are the Amazon of China, and they are the AWS of China, and they are also the OpenAI of China, because the Quen model is actually performing better on most metrics than any of the LLMs in the US.
Yeah, and I think it's also the extrapolation by most people of the real estate market onto the other sectors of the Chinese economy. So what gets the headlines is the bankruptcies in the builders and real estate companies, and everybody's just tarnishing painting everything with the same brush,
I think that's a great point.
which gives us the opportunity.
That's a great point, because that essentially is that's forcing investors to throw the baby with the bathwater. There is a lot of fear around this Minsky moment in China, this debt, the depression that they're going through in real estate. But at the same time, that's the germ for the consumption boom, because the only way you can revitalize the economy and maintain growth rates that are existential for the CCP is to boost consumption. And who is the beneficiary? Is PDD and BABA. I actually,
That's
if it
right.
wasn't for the AWS component of BABA, I like PDD better. But BABA comes with that appendix, which is so exciting, which essentially is you are buying a mutual fund or an ETF or a private equity funds on the entire AI ecosystem in China. And we just heard Jensen Huang said 50%, 50% of all the AI researchers in the world are Chinese working in China. So China is going to be, we like it or not, a cutting edge leader in artificial intelligence, and Baba is at the center of that. I think we like them a lot.
Right.
I'm so excited about this. And again, we're going to be talking about this in our next episode.
That's right.
So, in our recap of the last few episodes, we talk about energy. Energy is going to remain a key focus for us. We're going to continue discussing this opportunity and finding companies we like to invest on. We're seeing the hiccups that this boom in demand is creating, and we just found this piece where the Secretary of Energy is essentially complaining that they're going to be blamed for utilities price inflation due to all the coal capacity that was decommissioned in the last administration. And the reality is a confluence of factors, because we're seeing this spike in demand from data centers. At the same time, the prior administration, on the back of the Green New Deal, decommissioned massive amounts of very reliable coal generating electricity.
Yeah, and we go back to, just to give people a reference, our Technium theme is computers are going to compute, and at a faster rate and demanding more energy to do so. And that is just a secular theme, right? And what we've seen as the right way to play it is through natural gas, because that is the fuel for the next 5 years or so that that this Technium is going to use as its source of fuel. So that's why we're looking at these nat gas producers, primary producers, cheap producers, and what we're going to see is that energy bills are going to go up because the data center part of the pie is going to be growing, and at the expense of you and me, who are going to be paying ever higher bills because there's going to be a shortage of energy.
Well said. So here, where we're looking at is going back to your point on the Technium, is it's creating a very interesting set of winners and losers. And what the chart on the left stresses is how there are winners and losers, very extreme winners and losers in the technology space. And is in the technology space, we're seeing a bifurcated market, the same way we're seeing a bifurcated market between growth and value, between large and small, between domestic and international, even within the space. And I think a lot of the companies that are not in the AI cutting edge are suffering. A lot of companies that were entrenched in the software space are seeing companies saying, now we can develop our own applications. And there's going to be a lot of companies left on the side of the road. And then what does what does it all mean for us? It means that it's a stock picker market, exactly the market we've been waiting for so many years. A market where you can discriminate based on analysis and based on getting the trends right and capture opportunities for both long and short.
That's right. Um, there's a tale of two cities in just about every sector, and in the larger macro environment as well. So it is very interesting, but it does put the onus on very good security analysis and theme analysis,
Yeah, and there are
which is what we like.
is what we like. There are companies, great companies, that are also suffering. So it's not only companies perceived as having a weak hand in light of all the developments in machine learning and AI, but also companies that just wear over their skis. If you think in terms of Palantir, Alex Karp, I mean, it's a fantastic company, great leader, great CEO. They are changing the world. Now, its market cap reached 0.4 trillion, so 400 billion, and the revenues for the next year is 4 billion, which is 80% growth, but they're trading at 100 times sales. So there are.
Well, we remember a little company called Amazon that was doing the same thing, right? But there, yeah, truth be told, in Amazon's case, look at all the companies that were doing kind of the same on valuations and got left and ended up dying.
Yeah.
So
So we're seeing this sharp decline in the 1 year correlation between the S&P 500 daily return and the number of daily advancers, and that's showing that the market is now becoming significantly more discriminating, and that's a good thing. That's a sign of a healthy market that in many spaces, in many stocks, became too exuberant. And this is all around the same theme that we've been discussing, the theme around the fiscal dominance and the need to reshore. There is also a national security need to reindustrialize the country, because today the US cannot even produce the munitions it needs to supply Ukraine. Imagine if the US were to have a front of its own, it would be incapable of fighting any war. And I thought it interesting to bring back this seminal paper. It was very influential paper that showed the impact of China entering the WTO at the beginning of the century, and the US opening its markets to China, and what happened in the aftermath. And what happened in the aftermath, Paul, you and I have been discussing this for maybe 23 years, and how important this driver has been for the overall performance of the US economy. In the beginning, it allowed the economy to grow with little inflation. It allowed the US to fund the real estate boom that led to the financial crisis. But throughout all those years, the forgotten men and women of the US suffered a carnage. It was a real carnage in terms of millions over millions of manufacturing jobs destroyed, to the tune of $2 million when all the after effects and the aftershocks are taken into account. On top of that, because of the depressed pressure on labor associated with the import of cheap labor through Chinese goods, the wages of the US workers lost significantly and were lagged versus inflation. And in contrary to what the economists predict in terms of the economy absorbing those workers in other more dynamic spaces, this didn't happen. This carnage created what this paper called lasting scars, because employment rates, labor force participation, and earnings remained depressed for the rest of the time. And there was nothing that was done in terms of offsetting for all these people who lost their livelihoods associated with imports of cheap goods from China.
Yeah, and one of the things that gets me with economists is they say, well, we can calculate this, all else being equal. And that all else being equal is a big deal, actually. You know, you see a state like West Virginia where they not only did they erode the manufacturing base, but then on top of that, they started closing all the coal mines. So that state in particular had a double whammy, and it's sad because then people suffered a lot in those states, and there's what gets me too is that there's just a lack of common sense by the economists that were clapping at opening up the Chinese market to the world. They said, well, yeah, we'll have to get these people reabsorbed in other sectors. But the government never did any retraining. So the benefits accrued to U.S. consumers were at the expense of workers, and those workers were never either retrained because they thought that they would magically get absorbed into other areas. And that's just a lack of common sense.
Indeed. And it's very important to bring this back because it explains a lot of what's going on today. The whole theme around reindustrialization and reshoring is a sharp reversal of all these policies that created this state of affairs. And this state of affairs includes not only the destruction of manufacturing jobs, it includes the hollowing of the manufacturing base that supports the industrial complex in the US. It enabled the crazy level of debt that the US government incurred that we discussed in the last episode, driving the ratio of debt to GDP to 1.2 and making the debt path and the fiscal deficit path and the interest expense path unsustainable. So all of this is connected through the same theme, which is the China shock. The industrialization of China is the other side of the same coin of the deindustrialization of the US, the loss of US wealth, the loss of US jobs and wages, and the creation of this massive pile of debt that now needs to be restructured through all the measures that we've been discussing.
And there's also another effect, which is the polarization of incomes in the U.S., which has been very, very detrimental for society, and which leads us to extreme outcomes, either in elections and so forth. So, yeah, it's been very harmful.
That's exactly what the chart at the bottom is showing. What the chart at the bottom is showing is the participation of labor in the overall income creation of the country. So it's just indexed, but it's indexed, I think it's indexed 100 in 2010. And this is something that has been declining and declining. And the reason for that is exactly what you just said. While we are importing Chinese workers through the toys and the textiles and the manufactured goods that we import from China, depressing labor and wages in the US, we are enabling a boom in profitability and capital and wages and compensation for those who are not exposed to China competition, and that's exacerbating the wealth inequality. So a big contributor of wealth inequality is precisely the same, is the China shock. And if you look at the chart on top, it's dramatic, the amount of manufacturing jobs that have been lost. And there's been a gradual inflection since 2010 of this trend. And this is our view is going to continue. We're going to see that purple line extended into the future in an uptrend. It's very important to capture these epoch changes because these epoch changes are the ones that if you miss, not only you lose money in your investments, you avoid understanding and capturing the new winners that are being created because of this.
That's right. And another derivative of that chart up top is that commodity businesses commoditized businesses in the U.S. Are going to suffer margin shrinkage because as real wages start going up, that is going to impact profitability for equities that are traded. But at the same time, what we need to look at is focusing on sort of good franchise companies that don't have labor as a primary source of costs.
Such a great point. We funded our prosperity since 2000 over crushing blue collar workers, manufacturing, mining workers that are in spaces competitive with cheap imports. And what's going to happen now is that it's time for these trends to revert. And the only way these trends revert is over a process such as the one you just described, which is creating demand for labor, for domestic labor, for native labor that is going to drive wages up because sectors are going to compete for scarce labor. And you're going to start seeing, as we just saw with Jay Powell, that it's a bad thing to have wage increases because economists, how do they call that? Wage inflation. No. Wage increases is not wage inflation. It's the adjustment of a relative price in light of a scarce resource, which is going to become labor. So labor should become scarce. When labor becomes scarce, employers will compete for a scarce resource by bidding it up. And when that happens, it's called better living conditions for blue collar manufacturing workers in the US.
That's right. You know, as we look at it, sort of think through it a little bit more, there could be, let's say, consumer goods inflation if these wages do increase materially. I don't think there will be, because I think that's just going to erode more profit margins for companies that have a lot of labor, and they won't be able to get price increases through. And if they do, it'll be a very small amount, because, as you said, there is competition, and
Yep.
there will be competition.
Yeah.
And there always is in commoditized businesses, right?
Yeah, so
That's
I
why we
think
like-
you're right. The beauty of seeing this tsunami coming on, and this is going to be a decades long tsunami, is that, to your point, companies and sectors that don't have pricing power are going to see their margins erode, and companies and sectors that have pricing power and are at the cutting edge of productivity gains are going to benefit. And that's where we need to go and fish.
Yeah, you look at something like Coca-Cola. Coca-Cola does not have a terrible amount of labor, and because they are a wonderful consumer franchise, they'll be able to get prices up.
Yep.
If they do have margin erosion.
Yeah, asset light royalty franchises, as Buffett calls them, are beneficiaries of transitions such as the one we are embarking on. And the trade policy is just one of the legs on which this tool stands. The other leg, or the second leg, is the immigration policy. And the immigration policy, to the chagrin of economists, is shrinking the labor force. But which labor force? Is shrinking the labor force of people who came into the US to compete entry-level jobs and low-paid native workers. So once again, we were using the trade policy to crush blue-collar workers. We were using immigration policy to crush low-level workers, and those trends are being reverted. And once again, economists are going to say, oh, this is inflationary. No, it's not inflationary. It's the necessary adjustments that we need to revert a trend that hollowed the manufacturing base and created huge amount of pain in many American families.
That is right. And I guess the key thing here is that you're seeing a shift within a number, an unemployment number, where you're seeing increases in native-born workers versus deportations, let's put it that way, or exit of the labor force. And this should be of no surprise because Trump ran on this and now is doing what he said he would do.
Mm-hmm. Yeah. So signs, as the article says, are mounting that the foreign-born labor force is shrinking, and that's a good thing. It's going to be portrayed as a bad thing because it's being seen through the lens of capital, but through the lens of workers. This is a good thing. And if you are in your country, you should expect to have the right to a decent job and not be competed out by people that come into the country without having gone through the legal steps that we want them to go through. And this is a country, and I'm an immigrant, and I love immigration, and we should embrace immigration, and we should receive immigrants with open arms. But we need to have a national interest logic and filter through that, and we need to bring the people through the right channels, and the people who want to come and do an incredible job and love the country and be part of American dream. We cannot let people in simply to depress wages. At the same time, we cannot let Chinese goods in simply to depress wages, because as we saw, this became an unsustainable, completely unsustainable model. And the statistics are already starting to show this. On the BLS latest household survey, it shows the employed among native born grew from 131 million to 132.7 million, while the foreign born remain relatively flattish. So we think that this is something that is going to continue, and this is going to be a very positive development for the labor market in the US. And back to your point again, that's going to create necessary redistribution that not only is going to reward workers for their talents, it's also going to help reduce income inequality.
Absolutely.
And this immigration drop, it's starting in the chart up top. You have the foreign-born civilian labor force that increased like a rocket between 2000 and 2005, and since the administration took, you can see an inflection. You can see that trend starting to change, and we think that trend is going to continue. Now, there's going to be mechanisms to bring people to work in hospitality and leisure and agriculture, simply because there are not enough US workers for that. And I think the administration next is going to launch plans to do that. But they're going to be done in a way that do not create national security threats, and are done in a way that is harmonic with a healthy functioning job market.
Totally agree with that.
More of the same. The immigration policy used on the right hand side, you see apprehensions in the right hand chart. You see apprehensions of immigrants into the country, and it became virtually zero. In the three lines, the blue, dark blue is the nationwide border, and then the southwest is the light blue, and the orange is the north, and those numbers are plummeting to zero. And at the same time, you're seeing arrest and deportation. So this is what's contributing to this decline. The green arrow at the top in the right hand side chart, and that's going to continue, and that's going to put significant pressure. Now, what do you expect the reaction from liberal economists to be about these policies?
Oh, they would say it's heresy.
So
And
I
they
will
do.
have, what was your word? I didn't get it.
I said it's heresy.
Heresy, right? Yeah, yeah. I was very disappointed by people, complaining policies, or complaining about policies that are going to rectify a huge injustice that we committed with workers in this country. And tariffs, Lawrence Summers says, are pretty much all downside as economic policy. It's all downside. And Krugman saying this is regressive. This is a sales tax that is regressive, when what this policy is going to do is increase wages of manufacturing workers in the US and workers in general, because there is one labor market as well. And Kenneth Rogoff saying this is going to push up inflation, and this is what's so predictable, that we're going to call a natural adjustment in relative prices inflation, when in reality it's just rectifying the fact that we crushed labor in the US and created huge amounts of inequality. So policies, trade policy, immigration policy that rectify these bads are essentially criticized, but liberal economists that you would think are in favor of a better distribution of income and policies that favor those who are working with their hands at the lower end of the income spectrum.
You'd expect them to be egalitarian, and these comments basically are music to the ears of people that provide capital, oligarchs and so forth, which they are so quick to malign in other speeches. So it's completely completely nonsensical to me.
Yeah. And again, these guys are trapped in their Phillips curve, which is what they learn in Macro 101, and they could never, dispel that notion. And they think that when workers make more money, that's a bad thing because it's going to trigger a wage price inflation spiral. That's going to, be that needs to be repressed. Imagine if someone said, "Oh, because the companies are creating a profit spiral, we need to increase rates because they're making too much money." Or when the stock market is showing signs of frothiness and irrational exuberance, someone said, "Oh, but that's probably going to break the system and destroy the financial economy of the world," as is almost happened. And no one said that. It's only a bad thing when it's the workers who are being compensated better.
That's right.
And this one, I think, to me, was a pearl. Do you want to comment on this one?
Well, the what Jay Powell says is basically that he sees inflation coming from tariffs, and he also sees real income declines because of higher prices, which we proved last week in episode 3 that is not the case, that tariffs are not inflationary, and this setting of adverse wage price dynamics is I don't understand it.
So when wages keep up with non-existent inflation, that's a bad thing. So essentially, he's saying that I don't know where he lives, because on the one hand, he keeps saying that you cannot consider tariff pass-through inflation, but then he says if there is tariff pass-through, which is look-through, we shouldn't consider a look-through as part of monetary policy. But then he says again, no, but if there is tariff and there is pass-through, which is not inflation, which should be a look-through, we shouldn't consider a look-through if that creates a wage spiral. But essentially, he calls wages catching up to inflation an adverse dynamic. And again, this goes back to the same logic that these people have, which is a Phillips curve planted in their heads, and essentially saying when workers make more money, we need to go and tighten monetary policy so we don't let that happen. So it's really going to take to crack that code before we have a monetary policy for the new era, an era in which we have better income distribution, an era in which we have reindustrialization, and an era where we also need higher inflation rates to accommodate for all of this, given that we have 1.2 debt over GDP ratios. So it's incredible.
And here we see that manufacturing is increasing, which provides much needed blue collar jobs. And It was the promise that Trump made during the election, and he's delivering on it.
Yeah, and one of the interesting things, um, I saw Mohamed El-Arian comment on this, and he was saying that one of the biggest problems that the monetary policy has these days is that, in contrast to the Greenspan Fed, they don't have a strategy with a forward looking view. When Greenspan was confronted with the dot-com productivity boom, he fought to keep rates low because he anticipated the productivity gains that were going to happen. And that's how he earned the nickname El Maestro. He had a view, he had a theory of the future that allowed him to look through the windshield rather than the Powell Fed that is all the time talking about data dependency. But data dependency is looking through the rear view mirror. So he doesn't have a view. That's why he thought inflation was transitory. That's why he thought tariffs were going to be inflation in Trump 1.0. And now again, they're lacking a view. Hopefully, the next chairman is going to have a view of the future that enables a monetary policy, that allows a monetary policy that makes room for all these adjustments that we need. And we need labor to recover its share in the income distribution. And we need inflation rates that enable the government to remain solvent, right? So unless they start looking through this strategic lens, it's going to be a tug of war between the fiscal and the monetary policy.
What the Fed needs to realize, and very quickly, is that they're in a fiscal dominance scenario, and they have to wrap their heads around that and get with the program with Treasury and absorb the issuance of Treasury, because they are going to be the buyer of last resort.
Yeah. So
But they
today,
haven't
more
even
than
done
ever,
that yet.
we need a coordination between the fiscal and monetary policy, and
That's
a
right. But they're
chairman
not
that
even close. They haven't
no, we're not
even
even close.
realized we're in a fiscal dominance scenario.
Yes, and we're starting to, again, to see, um, and I think these trends are going to continue, which is real average hourly earnings increasing year on year now for 27 consecutive months. We're seeing factory activity expand. This is only going to continue. We had the one of the longest time we have one of the longest stretches of ISM below 50 in history. And all those things are going to start reverting only when we have a Fed that understands that we need it to be more accommodating. And if you look at the history since Nixon through today, there were only two other times when real blue collar wage growth was positive, and that was in the first Trump administration and now in the second Trump administration. This is an
That's right.
indictment of the economic policy associated with this big headed notion that we need to embrace free trade. We need to let the Chinese workers to compete with American workers through cheap goods. And we need to further crush the US workers by signing deals with free trade with Mexico. And when that's not enough, import, low skilled workers that compete with entry level jobs and low skilled workers in the US through, uncontrolled immigration. I think that's changing. That's changing for good. And even if there is no, similar color administration in the next few years, I think people are not going to tolerate the carnage that happened through these, completely ill-conceived policies over the last 2 decades.
That's right. And we are also at a Wile E. Coyote moment.
It's
And this is
important to, yeah,
and this goes to our review now of the persisting theme on all our episodes, which we are in an expensive market overall, bifurcated, but with an expensive market.
yeah. And there is a wall of world central bank liquidity, as we just saw. 88 cuts by foreign central banks. That's creating a sharp increase in the central bank liquidity. And that liquidity is going to find a home. And that liquidity is coming from everywhere. In China, they are going to be goosing the economy. As we saw, they don't have any other alternative. And that money is going to go to both legitimate and illegitimate places. We're not going to name illegitimate places, or we're not prejudging. Something that we may consider legitimate may be perfectly fine. It's just that out of our investment philosophy and style, there are certain things that we just don't do. But the money is finding its way to meme stocks, is going to find its way into SPACs, is going to find its way to very suspicious IPOs. And it's also finding its way, and this may be a very legitimate use of capital because it's related to fiscal dominance and stable coins and the need to control the yield curve through financial repression, such as Ether and other cryptocurrencies that enable the tokenization of assets.
Yep, I agree.
And we
It's just
see
massive liquidity.
this Peter Thiel. Peter Thiel is a very smart man. And Peter Thiel is one of the sponsors of Bitmine immersion technology, the same as Duquesne family office, right? And there are no dummies in any of those places. And when I see a company such as BMNR becoming the 10th highest day average daily by volume, that calls my attention because something is going on there, and is something that maybe we don't fully yet grasp. Even though we understand fiscal dominance, we know that there's going to be stable coins that are necessary to amplify demand for bonds and contain interest rates. This is very interesting because this may well be one of the big trends in financial markets over the next 2 decades.
Yeah, I don't understand the Ether, Solana space. I know a little bit about Bitcoin, but yeah, as you say, it's grabbing a lot of attention. It's grabbing a lot of dollars. So
Yeah.
it's probably
So
something to
the
understand a
fact
little bit
that
more.
you can use crypto technology to codify contracts in a very efficient, frictionless manner means that many actors in the financial world will be attracted to do that. And when they do that, and when they outsource the contracting or the administration or the trading of assets through one of these crypto platforms, crypto layers, they pay what the ecosystem calls fuel, and that fuel is paid in those tokens. So that creates a potential large demand for a relatively scarce assets, and that's what people like BMNR are doing. They are becoming a treasury company for Ethereum in this case, and the Ethereum is the largest of those platforms, of those layers, where you can again codify and automate and in a frictionless manner transact financial assets and other contracts. And when people are attracted to this, and this is value creation, they need to pay, they need to acquire those tokens. And when they acquire those tokens, they create demand for those tokens, and these companies get paid also dividends from staking, because these are not proof of work, they're proof of stake platforms, and they pay by staking their tokens. And by doing that, they create a potentially very, very legitimate and attractive model. So even though I'm in your camp, I don't fully understand this, I think it's a very exciting new technology, and I'm going to be looking at it with a lot of interest and a lot of curiosity because it may turn out to be transformational for the foundations of the financial system and the financial infrastructure that as we know it today.
Yep.
So to your point earlier, things are very expensive. Um, this you like this chart?
I love this chart. It just shows you sort of the road we were on up to the 2000 bubble, and how we compare now, and it's kind of scary. It's it's gonna. It seems like it may have a little bit more to go, but it definitely looks like a similar pattern. And we've got a lot of ingredients to call a bubble. Maybe not exactly now, but certainly soon.
Yes, yes. And if history is preface, we may still, a couple of innings to go before this thing reaches its apex. And
Yeah, and here we can see that the Mag 7 stocks are increasingly have an increased share of the S&P 500, but now as a share of income, they are starting to lag, which is very interesting. That's a very interesting dynamic.
Yes.
And well, here, this one's just really interesting because it shows you how just Nvidia and Microsoft are reaching sort of what 4 entire sectors are of the S&P 500. Those being staples, consumer staples, energy, healthcare, and utilities. So this is another one of those sort of aha charts. Now, it's getting euphoric, definitely. Barclays indicator is saying the same thing, but we always have to remember, keep Japan in the back of your mind. They went to 65 times earning the Nikkei. So these are tools that sort of give you a sense of probabilities, but you shouldn't use them to call a top or a bottom.
Yeah, 100% agree. I don't think we're there yet. I think this can go for a while, and this may well become the largest bubble of all times. I personally think we are in a bubble, but the fact that you are in one doesn't mean that the bubble cannot become double, right? I think
Exactly.
you mentioned when Jeremy Grantham exited Japan, right?
Oh yeah. I think he exited when it was at 25 or 30 times earnings, and then he said, we've kind of gotten the top, we think, and then it doubled.
It doubled to 60. That's exactly right.
Yeah.
So he saw it go from 15 to 21, and he thought it was crazy. Then he saw it go from 21 to 24, and he thought it was crazy. Then he saw it go all the way to 30, and he said that this is unsustainable. He got off, and the whole thing doubled afterwards.
Yeah.
And then it declined for the next 3 decades?
Yeah, it was about 3 decades.
So I mean, these things can go way longer than you think. The other thing that we know is that they don't adjust by going sideways.
No.
And so when it comes down harsh and for long.
That's right.
Yeah. So here, just I thought it interesting to have a perspective of earnings per shares growth, because we're looking at 22, 23 times forward earnings. So that's a pittance of an earnings yield for the Standard and Poor's that is going to be growing at 7% in the next 2 quarters. So we may have a hiccup in the next 2 quarters before earnings growth reaccelerates into 2026. There are probably some reasons for that. Clearly, the tax reform is one. It's giving a lot of benefits for R&D and capacity expansion that can be immediately depreciated, expensed, essentially. There's going to be a lot of reshoring. Many of the investments tied to these trade agreements are going to also be consummated in 2026. So there's going to be significant impulse from all these initiatives that may continue driving earnings. That's why, even though we know we feel that we are in bubbly territory, that doesn't mean that this thing needs to pop up immediately. It can go on for a while. At the same time, as you were saying, Paul, it's a very bifurcated market. So you don't have to participate in crazy town. You can go to sanity town, put your chips there, and just witness how the rest of the people party in crazy town.
Yeah, and these EPS estimates, you also look at it against the backdrop of seasonality, which tends to be weak in October. So your call for maybe a hiccup in October might be prescient.
Mm, yeah, I wouldn't bank on it. My timing is atrocious. If I was if I was a trader, I would be bankrupt, not rich. So at the same time, as we were saying, you can go and park in equal weighted index. You can go and park in small caps that are very cheap. They are, I mean, again, opinion, not advice. I think they are generationally cheap. Generationally cheap. If you know where to fish in the small caps universe or in the mid cap universe, in the next 10 years, you can make another fortune.
Yeah.
So I think that's a great opportunity. We're going to continue pounding the table on this. Small caps did better after initial volatility around resumption of cuts. So that's the chart at the bottom right, and we are embarking on a resumption of interest rate cuts by the Federal Reserve. That's very bullish for small caps overall. And if you're fishing in the right ponds within small caps, because there is a lot of zombie small caps in the Russell 2000, but if you go and find solvent companies that have low leverage, that have steady cash flows, healthy businesses, shareholder friendly management teams, we're going to be seeing doubles, triples, and quadruples in that space in the next few years. So I'm very excited about that. It's the theme we're going to be talking in our next episodes. And today, when we jump into the housing discussion, we're also going to identify a few players that are really nice ways to bet on the housing renaissance that we believe is going to happen in the next few years. Again, here, growth to value, insane. You don't have to participate in crazy town. You can go to, sane town. Retailers continue to be a formidable force, buying triple leverage, long options, right? And that's clearly one of the fuels that has characterized the market performance since the COVID pandemic, right, Paul?
Yeah. Increase speculative further.
Yeah. I think some of the excess money that was helicoptered in the different programs to face the pandemic are going to be mopped. And I think that unless we're right on the recovery of real wages, retailers might not be such a big force going forward. I mean, the savings rates came relatively low in the last PCE report at 4%. We're seeing increases in delinquencies in many spaces. People are now having to pay student loans back again, which were fuel for this fire during the Biden administration years. So I don't know if I would bet that they're going to be such a strong force in the next few quarters. And we touched on this last time. And Charlie always says he quotes the famous mathematician Jacobi, who said inverts always inverts, and that's logically true, right? In mathematics, if you cannot prove the theorem A then B, is if you can prove no B no A, is logically equivalent, right? So um, we cannot say bubble then concentration, but we can say no concentration, no bubble, right? And we saw it last time. There's never a time in which we didn't have a bubble with high concentration. And right now, the levels of concentrations are absurd. So we have 10 companies, 10 companies in the overall Standard & Poor's 500 index that account for 40% of the market cap. Just put that in the pipe.
That's amazing.
So it's not even an index anymore. It's 10 companies and the other 490 dwarfs. And the percent of companies in the Standard & Poor's 500 that have more than 10 times price to sell ratios reach 25%. So it's concentrated and expensive.
Yep. It is amazing. And when those 10 companies go down, they drag down everything with it.
Yes. And the insiders know it, right?
Yep. They're heading out quickly.
Yeah, they're saying just Alex Karp just sold 70 million in Palantir's shares last week, and this is insider selling is only been increasing over the last few quarters, and it's sensible, right? I mean, if people pay crazy valuations for my company, and I know even though I may believe it's a fantastic company, why wouldn't I sell?
Yep, exactly.
So just to wrap up, valuations are extreme, but you don't have to live in the extremes when the equal weight is fine. And there are areas where we like much better. If you look at the Goldman Sachs commodity index, it's at historical low. So same comment we just made for small caps. I think we are at a time, if you decide to invest today in commodities, and again, opinion and advice, consult your financial advisor before making any investments. Returns are going to be generationally high in the next 10 years in commodities. And within commodities, what do we like, Paul?
Lithium. We like lithium. We like copper. There's a few good commodities that are going to participate in our themes, and we think lithium is a big one, and copper is also another big one.
Yeah, and they are they're cousins in their complementarity of their uses. Yes. Because it's just right. The electrification is going to drive demand for both at the same time. And Morningstar just this past week came up with their list of the 12 best basic material stocks to buy right now. And look at who's number 1, who's number 2, and who's number 7. Not that we need them to confirm, but people are awakening to our thesis.
Yeah, they're starting to wake up, but this is a long game.
This is a long game. Yeah, there are some companies that I don't like at all, but I like Albemarle. I like Celanese. I like the chemicals. I think the chemical complex is also poised for a turnaround. I think the big part of this depression that we're seeing and you know this space very well, around polymers and feedstock for the plastic industry and etc. It's tied to Chinese subsidies and overcapacity. And I think that anti-involution policy that we discussed in the context of the lithium mine being shut down for contemporary Amperex is going to also bring capacity constraints in the chemical space. And that's going to favor all these companies. So I like the way they're thinking, and I think there's going to be opportunities there. This is also something that you told me several times, which is you've been very focused on the capex and the returns on capex. You brought up that article from Amazon discounting server capacity and to what extent returns were going to come pari passu all those investments versus just dilution of EPS for shareholders. And MIT came up with this research, which I thought was earth-shattering for the industry.
And this tells you that just like the build out of fiber optic cable networks in the early 2000s, we might be having another cycle of this time with AI infrastructure. And it brings me back to something Warren Buffett said if you took all the airline industry across time and said, okay, did it return anything? And the answer is probably returned zero, or it was a negative return
Mm-hmm.
for all airlines across time. Um, and when you saw Wilbur and Orville take off in the plane, you probably said, "Oh, this is something I need to get in on,"
Mm-hmm.
and it wasn't the case. So we always have to be careful, and this is also a good chart which shows you the magnitude of increase in capex over time. And like I said, they better find a great use for it, because it doesn't seem to me like there is much of one now.
Yeah, I think odds are very high for a multitude of. You cannot be certain on any of these things, but odds are very high that it's going to be a lot of value destruction, and it's going to be concentrated among hyperscalers, who are the ones bearing the brunt of this capex investment, as we show in the chart on the left hand side. And if you look at Oracle, Meta, Google, Amazon, Microsoft, those guys reached 250 billion, right? These numbers are so staggering. We lost sense of how humongous those numbers are. And I mean, it's the market capitalization of entire. They spent in capex the entire market capitalization of many European countries. um, and if you put that in perspective with the dot-com era boom, it dwarfs its as a percentage of GDP. So as it's portrayed in the left-hand side chart. And if you start adding the fact that people are not paying for this, the fact that all these players are obsessed with scale and they need to do this not because they love it, but because they don't have a choice. They cannot be left behind. They're protecting their old franchises by doing this. And they're doing this at a time where valuations are very high. um, I'm very skeptical this is going to pay off, and I think we're going to have another disillusionment in the next few years. But again, we don't have to participate in this. We can participate in the picks and shovels. We can go and buy the KLAs and the Lamb researches and the Applied Materials and the Novas and the Teradynes and so on, and just witness crazy town and how they get drunk and crash and burn. So it's
That's right.
it's the best of all worlds.
Agreed.
Productivity is what you just said. It's not coming in line as the white line on the left is indexed as of the time that ChatGPT came out, and the line in blue is the similar line for the dot-com era, for when Netscape released its navigator. So productivity is lagging. And one of the things these technologies do is they disrupt and destroy entire industries. So if you think in terms of internet enabled digital cameras, and then digital cameras enabled the smartphones, and the smartphones killed digital cameras. But in the process, where is Kodak? Where is Fujifilm? Where are all these? Where are the CD players and the CDs? So it's going to be a lot of disruption, and when there is this disruption, and stability is the enemy of returns. You need to be in places where you have a lot of boredom in terms of what's going on, if you want to have any chance of durability in returns. This is going to create a lot of havoc in many areas and many value destruction. This is for another day, but that's one of the reasons I think the GDP I completely mismeasured, because we take probably thousands of order of magnitude more pictures than we took when we used the film photo camera, and all that GDP went from all the GDP associated with cameras and film to zero, because not a single of the pictures I take with my phone are accounted for in GDP. The same thing with all the emails we send back and forth, and so on and so forth. So there's going to be a lot of havoc. AI is going to be a boon for humanity and research and advancement of science and technology, but it's going to leave a lot of corpses at the side of the road.
That's right.
So this is what you've been saying, right? Large is not a place, small is a place to be, value and international. And again, when I see this chart, it makes me tremble in greed. If yeah, it's truly a generational opportunity to mint money. Opinion or advice, everything we say here. But if you know how to play this, it's going to be an amazing opportunity.
And now we get to fun part, real estate. Here we can see the ratio of U.S. real estate to the S&P 500, and it's another generational opportunity. And here we also see the unaffordability of on a national basis relative to earnings, hourly earnings, and also the affordability gap is, we can see it right there on the right hand side as well.
It's staggering.
It is staggering, and yeah, there is something to be said about markets being different one from another, and I think we're going to bear out the differences between certain types of real estate, be it vacation properties and what boomers own and what young people can afford, or shall we say not afford at the moment.
Yeah, this divergence on the left, post 2020, between home prices, post pandemic, because of the pandemic in a big part, and average hourly earnings is part of the story. But then the 57, that means that for the median household to afford a median priced home, their income will need to be close to 60% higher than what it is. So that's a combination of both the increasing prices over wages, but also the dramatic spike in mortgage rates since the Fed started tightening and quantitative easing, right?
Right, exactly. Yeah, we can see it, prices have risen above pre-COVID levels, and we also see that there's been a disappearing of housing inventory as well.
Yeah, and this is creating a lot of political heartburn, and that's the reason why we saw this massive um, bill that came out of the Senate Banking Committee for the first time, I think, in how many years, with unanimous support from both Democrats and Republicans.
Well, that's right. People are getting out the pitchforks now, and if they don't do something about it, they're going to get skewered.
People are desperate,
People,
and you have millennials, needing to start families. They are in family formation, you know, years, and they are completely priced out of the market. Even those who make, a very decent living.
yeah, it's when there was statistics about households, and I think it's now at 2.3. The people in the average household, and and it's been rising, and that's probably due to kids moving back in with their folks because they just
Double
can't
down,
afford. Yeah,
baby.
yeah,
Yeah, it's brutal, and it's so unfair,
yeah.
and it creates so many other societal problems. So I think the pressure for regulators and monetary authorities and and policymakers in general to bring solutions to this space are becoming are at a breaking point.
Yeah, no, absolutely. There's it's such a big cohort of U.S. population that you don't want to have them angry at you if you're a
Yeah.
politician.
And this chart talks about your point about being two markets, right? I think there are many markets, but at least two between new single and existing homes.
Yeah, that's right. Existing, you know, we have a pretty decent supply of existing homes. You can see it's the highest since 2016. Um, but the problem is those existing homes are very expensive relative to new homes.
Yeah, so new single family homes have sharply increased, and we have the highest inventory today since 2007, which is a lot. And this is builders building like crazy in the Southwest post COVID, and in areas where people were migrating into, and in states where it's relatively frictionless to build. There we still have, especially in the north, in California, the poor souls who lost their homes to fires have not yet getting their permits to build back in California. So it's like
Yeah,
that's why people are living in mass. So it created this highest inventory. But as you said, in existing homes, I think that inventory is going to continue going up, and homes are going to sit in the market without being sold. By the way, I'm in one of those homes who are going to see sharp price declines in the next 5 years.
well, but that's where you live, so
That's
it's not that big of a deal. If it's an investment property, then uh, I'd probably have something to say. But no, if it's the house you live in, uh, that's always a good thing to have. And you don't really care about pricing on the home you live in.
that we shouldn't. I care a little bit.
Now you can see that that big divergence between you know the existing homes versus new homes, and it's cheaper. It's cheaper to buy in.
Which is unheard of, because if you look at all the history as portrayed in this chart, logically newer homes command a premium over existing
Yeah,
homes because they're new, they are
yeah,
fashionable, they are built with the latest appliance and the latest functionalities, and they're more modern and they have better designs. And now we're seeing a reversion of that. It's incredible.
yeah. And look at the chart. You haven't seen that. This goes to what, 93,
Yeah.
and it's never been it. You've never seen that dynamic.
Yeah, so it's telling about the dearth of supply so far in existing homes, the increase in supply in new homes, and that's going to be that's going to be like a rock around the neck, an albatross around the neck of
Right.
existing homes, because that's going to drag that price down, and that's why we're seeing many existing homes sit on the market for a long time, right?
Yeah, and look at where the cohort in the demand is. It's with millennials, and millennials are um, the ones that would be buying the new homes, and they can't afford the existing homes because
Yeah,
the existing homes are probably bigger. They're the boomer homes, which are more expensive, bigger, much more land
yeah.
in square feet built. So you're having this sort of a tale of multiple cities, if you will, within the demand structure, and this is very telling
Yeah.
of that demand.
And I will posit that there are even behavioral differences because in new homes the builder builds and then they need to sell.
Right.
So they will do the mortgage rate buy downs. They will adjust the price. They will adjust whatever to make this thing until the supply becomes so large that just market forces take over. And I think that's what we're starting to see. And we see in the chart on the right hand side, we're seeing price declines in 27 major U.S. metros. That's probably a mix of existing, but we know that in many metro areas, existing homes are also seeing price decline.
Yep. No, that's right.
And we are seeing a very healthy household balance sheet. We showed this chart before, but the mortgage LTV, which is how much the overall gross value of mortgages represents over the total value of the home, is only 28%. Typically, when you buy a home in a conforming mortgage, your LTV is 80%. So you only put 20% equity. The rest is mortgage, is financed into the future. And right now those numbers are at 28, and the reason is people are trapped in their mortgages and they've been amortizing. So they bought a home, they refinanced at 4%, and rates went up. So they have these golden handcuffs. They cannot get out because if they're going to sell their homes, where do they go? They need to buy a new home, and you cannot port your mortgage. So they need to get a new mortgage. And what's going to be the rates in the new mortgage? What's like, pick your number, 6, 5, 7, right? So they are trapped in their old homes where they continue paying their mortgages. They bring the balances down, but they cannot move because they cannot afford a new mortgage. So that crazy high mortgage rate for the default rate that people have makes the market trapped in itself. There is no churn. People don't get out, and the ones who want to buy a new home have this affordability wall, right?
No, and that's also very probably one of the reasons too here is that a lot of boomers are probably near paying down uh, all the mortgage, so they're sort of at the last end of the mortgage timeline.
So there's going to be a huge wealth transfer that is going to include homes in the next few years from the boomer generation, and those homes are going to eventually be sold, and those mortgages are in dire need of being refinanced because these people have other bills to pay. And when rates are so high, they have all this equity they don't need. If you are in your 80s, what do you need 80% equity in your home for? You need money to visit your grandkids, to travel, to pay healthcare. So there is a lot of pent up supply of homes. There is a huge pent up demand of cheaper mortgages, and there is a massive pent up demand of the millennials you mentioned. So there is a tsunami of transactions waiting to happen in real estate, and the only block are rates.
Yeah, that's right. And I'd also say that the boomers is a cohort that obviously is going to be shrinking over time, but the properties that they own, when the kids inherit them, they're probably not going to live in them, and they're going to have to sell them so that each kid gets their share. Um, but the problem there is that you're going to progressively increase the amount of supply to market of existing homes over the next few years, and those are not necessarily homes that millennials can buy because they'll probably end up being sort of bigger homes, um, and the affordability gap tells you that they might not be able to afford those homes on average. So there's the existing homes are going to have to come down in price um, materially, so that they also come in line with existing excuse me with brand new homes. So
Bingo.
that mismatch that we saw in that chart needs to come down, and the only way is by price through sales and price reductions.
Yeah. And mortgage rates are the evil of all evils, right? And it was
Yep.
preventing all this equity trapped to be freed. Is what's preventing 80 million millennials to start their lives. Is what's preventing all these boomers to exit their mortgages or their homes or refinance. And again, we're seeing the pressure from the administration on the Fed to reduce rates, but that's not going to be enough, because if you think that in September rates, Fed funds came down 50%, and the 10-year bond went up. Actually, not the 10-year bond, the yield on the 10-year bonds went up, putting pressure on mortgages. Right. So now, more recently, there's been a compression on the spread. The 30-year mortgage, which is like the gold standard of all mortgages, the 30-year fixed rate mortgage is priced out of the um, 10-year bonds, and that uh, spread came down recently, creating a little bit of relief. But we need those numbers to come dramatically down. And one of the things you mentioned in the last episode is Operation Twist. When the government puts pressure on the Fed
Right.
funds, that comes down, the government can shift its funding, as you explained, to the short term, and it can even buy bonds at the 10-year, right, putting pressure down, and that's going to bring further relief. Again, I don't think that's going to be enough, but it's going to contribute a lot to this phenomenon. So and here we have exactly that. Why do we say there is pent up demand for lower rates? Because all these loans are at rates significantly higher than the ones we have today. The typical spread between the 10-year bonds and the 30-year fixed rate is about 150 bips. That means 1.5%. Today, that spread oscillates between 240 and 270, which is a 50-year high. And the reason for that is that people, during COVID, when rates went to zero and you can get a 30-year fixed rate for 3.5, refinance refinance their homes. And when rates went up, that meant that no one was exiting their existing mortgages, which increased the duration of mortgages way beyond the typical term. And that means that MBSs, so mortgage-backed securities and mortgages today, are priced as if they were a 15-year bond, and therefore they have these
Mm-hmm.
dramatic spreads. So if you think that we can ease 100 bips, if we can ease 100 bips, the Fed funds, we can do Operation Twist, or people can get, interest only arms, or they can get 5-1 arms that are priced at the 5-year term. Then we can bring mortgage rates like 220 bips, which is 2.2 percentage points, and that's going to put at least 50% of all mortgages at play. And that's going to free up a dramatic amount of mortgages. And we think this is exactly what's going to happen.
So a boom in mortgage transactions.
I think it's going to be a boom in mortgage transactions. In mortgage, it's going to be a boom in transactions because people will be able to sell their homes and buy a new home once the rates are low. Even if you want to downsize your mansion because you are empty nester and you don't need, 5 bedrooms with inside pool and like tennis courts, and you want to go, for a smaller home, you can't do it because you cannot afford the mortgage of the new home, right? I'm exaggerating the case. But when rates come down, people will be able to, have the opportunity to buy a new home, which unlocks the sale of the home in which they live today. And if we bring rates 150 to 175 bips, you can see what it does to your mortgage payment. Even in a starter home, like an average medium price home at $300,000, the mortgage on average will come down 20%. That's not small potatoes.
So it's a 20% savings on your mortgage.
Yep. And this is the point we were making earlier. On the left, you have the prevailing rate for the 30-year fixed rate mortgage. And on the right, you have the distribution histogram of outstanding mortgages. And at prevailing rates, more than 80%, at least more than 80% of mortgages are set at a rate below the prevailing mortgage rate. So when we bring that down 200 bips, 175 bips, that frees up a huge percentage of mortgages that right now become golden handcuffs for their holders.
That's right. So this adds a little bit more, a little bit more fuel to the fire on our belief that transactions, any company that benefits from the amount of transactions, a rising amount of transactions, is a good play.
Absolutely. Yeah, that's exactly right. This is what this chart on the left shows. Effective mortgage rate 4%. If you are going to get a mortgage today, you cannot get it for less than 6.6. Most people have positive equity, so that means they can get out and get equity from their homes, and that's going to be a huge fuel for a transaction. And then you have large excess of sellers over buyers, which is going to, all of these things are going to contribute to affordability. Because if you think, how is affordability built? The price is coming down. That contributes to affordability. The rate is coming down. The spread is coming down. So we have this excess of sellers over buyers, and that's going to drive prices down, and that's going to contribute to affordability. We're going to have the Fed forced to reduce Fed funds rates. They already almost committed to reducing rate in September, hopefully 50 bips. They're going to reduce rates 100 bips between now and the same time next year. That's going to, by definition, reduce the duration of existing mortgages because people are going to be open to changing, swapping their mortgages, refinancing, and that's going to bring the spread down. Probably there are going to be also some measures in the MBS space to compress spreads. So that's also going to help with affordability. As we saw, you have the trade policy reshoring, creating demand for labor and putting a boost on wages. You have immigration policy restricting immigration of workers, therefore also pushing wages. And employment is going to improve as well, as we saw, employment of native born workers. So everything is going to move in the direction of improving affordability. And I think that's going to drive opportunity for first time home buyers. As we see on the right hand chart, they used to be 40% of total home buyers, and they've been reduced to 24%. And that's
That's right.
obvious. The only people who can afford a home are the people who already made their money. But these millennials who are starting their professional careers, they haven't had the opportunity to amass, even the down payment, let alone pay for high mortgages. And therefore, those people are going to be fuel to the opportunity as rates come down and as prices come down and affordability improves.
Absolutely.
This is another driver of prices coming down because multifamily vacancy index is high, so it's cheap to rent. So if you think the chart you showed us today earlier is new homes are cheaper than existing homes, and renting is cheaper than new
It's cheaper
homes.
than owning.
Exactly. So that's everything is going to drag down prices. So I think people who think prices are going to remain stable or increase, there's always maybe the odd market in which, for whatever funky reason, prices come up. But on average, prices are coming down. I'm very, very optimistic that affordability, one way or another, is going to improve. There are many, many reasons why, even if one of the reasons fail, there are many other reasons for affordability to come up.
Yeah, no, I agree. And there's another pressure point, which is also state and local taxes
Mm,
um,
right.
on homes, and those have been increasing.
And
Um,
insurance. It's been
and
crazy.
insurance, it's been nuts. So those things also have been adding to the unaffordability of homes, which as a tenant you don't have to pay, right?
No.
So
So
that's
it's
why people are
somehow included in the rent, but yeah, if you're an owner, typically owners, we're not expecting to. You can always, if you're a tenant at the end of the lease, you can change, neighborhoods or city. If you are an owner and you're locked, the thing is you are locked on your low mortgage. So if tomorrow the city decides to increase your property taxes, or the insurance company, because you live in a hurricane prone area, doubles your insurance premium, there's nothing you can do about it.
that's right. You have to eat
Uh,
it because also the rental market is now competitive, as you mentioned, because of the vacancy rates. So
exactly.
the alternative basically makes the landlord eat the increases in state and local and insurance, state and local
That's a
tax and
great point,
insurance.
and that's the reason why cap rates. That's I didn't know why. Now I understood. That's why cap rates are so low. Cap
Mm,
rates for apartment rentals are like 4%, which is the same as a 10-year bond. What will you get into
right,
that mess when you can buy a 10-year bond?
exactly.
And this is what you were saying, right? I mean, we made a whole generation of people renters,
Yeah, no, that's right.
and these people, many of these people today, about 1 in 4 of 1 out of 4 of all the renters in the millennial generation would qualify to buy a home, and they have, they can afford it. When rates come down 175 bips, I would say that 2/3 of that population will buy a home. So there's going to be a tsunami of demand for homes. There's
Right.
not going to be enough entry level homes to go around. And that's going to drive another mini construction boom. And that's going to drive in entry. By the way, I'm not talking about the McMansions in the suburbs. I'm talking about entry level homes. I'm talking about apartment like substitutes. I'm talking about, properties in places where young people want to live. In those areas, there's going to be another mini boom, and that's going to drive a huge boost in economic activity, employment, wages, and this is going to become like a virtuous feedback loop.
Circle. Yeah.
So prices are coming down, as we saw. Demand is there. It's only being stopped by high rates. The administration understands the problem very well. The Fed is going to be easing. The spreads are going to be coming down. Wages are coming up. Builders are ready to build. And, as we say here, the policy rate is keeping the market as a ratcheted coil spring ready to explode. And I think that's why these are some of the ways we like to play this huge opportunity that is coming our way.
Those there are some great investments there. Mohawk, Rocket, Nucor, Freeport McMoran, Boise Cascade. There's some very good names here.
So these companies, some of them are iconic. You were calling my attention about how storied Boise Cascade is. And these are companies that are great businesses on their own right. Just look at the return on total capital and the return on equity that they have. Um, with the exception of Rocket, because that's not the right way to measure their profitability. Historically, it's a mortgage broker. Now became a servicer and also a real estate broker with the acquisitions of Redfin and Mr. Cooper. So it became like a fully real estate
Yeah,
integrated transaction service provider. But with the exception of that, all these companies are great businesses on their own right. By the way, look at the disclaimer at the bottom right of the page. This is all opinion, not advice. And these companies are showing this performance at a very low point in their cycle because, as we
That's
saw, we've
right.
been in a mini depression in manufacturing, right? So if you think that these companies manage to maintain gross margins, to deliver these incredible ROICs, to deliver these incredible returns on tangible assets, these companies are also a cold spring when and with significant operating leverage to the housing recovery. So they are relatively cheap today. They're going to become outrageously cheap when that happens. We don't know when it's going to happen. We know the what, not the when. We know this is going to happen. It's going to be a function of all these factors that we just discussed. The other thing, Paul, and I love about these companies is these are shareholder friendly management teams. They
That's
pay
right.
dividends, they do buyback yields when it's the right time to do it, and they have a relatively high shareholder yield. Look at BCC, have 12% shareholder yield. It's amazing, right?
Yeah.
And they are like at depressed levels of operating cash flow today. That cash flow was like 3x 3 years ago of what it is today. So I'm very excited about this opportunity. This is just an illustrative list. Everybody has to do its own research and find their own, gems. But there are many opportunities out there to benefit from the recovery and the renaissance and the initiatives the administration, Congress are sponsoring for the housing market.
And also Freeport fits in with one of our previous theme, which was gold. They produce not only copper but a sizable amount of gold, so it fills in two buckets that we have.
And they are a beneficiary of the electrification trend as well.
Yep, that's right.
The other thing about that list is like shooting fish in a barrel after you drain the water.
That's right.
so, I think these are just a handful of opportunities out there. And the other thing about this list, I don't know if FCX qualifies, but the other companies, yes, these are small and mid cap companies. So it also
Yes.
checks the box of small cap value. So they check many boxes. They are material companies, they are in small cap, they are values, so they're beneficiaries of rate reductions, they are levered to the housing boom, and they are incredibly, in our opinion, cheap and affordable at this time of the cycle. So Paul and I are super excited to discuss these companies and to invest in them.
Exactly. Yep. We're going to look at valuation arbitrage, and this will be a two-part series, with the first part being emerging markets and the second part being small cap value. And this is been this will be a fun one to do, uh, and it's very prescient to what we're looking at.
Yeah, no, this is exciting. These are exciting times. There are many opportunities. Um, it's somewhat perplexing to us that people are so obsessed with the most egregious, expensive corners of the market instead of capitalizing on some of these opportunities. All the theses are working out. The only one of our six themes that hit a hiccup is number one, the picks and shovels in the short term. But I'm very optimistic about the trend in the long term. The other ones are working well, and many, to your point, many of these opportunities check multiple boxes, so they can be put in
Hmm.
many of the themes. And I think that makes for very exciting investment opportunity set.
Wonderful. So we look forward to you guys joining us on episode 5. And remember, if you liked what we discussed, hit the subscribe button and keep following us.
Awesome. And they can also follow us in our WhatsApp channel, Compounding Brothers, where we're putting loads of information and describing financial events every single day. Take care, my
Exactly. That's a
friend.
good one to follow. Exactly.
Take care, my
All
friend.
the best. Take care.
Bye.
Bye.